Business Organizations 101. The first form of business we talked about was the sole proprietor, which is the default form of business for an unincorporated entity consisting of one individual. Nothing required in terms of filing. Simply be in to do business, put out a sign. The advantages obviously are the simplicity of formation. There's nothing required. The revenues and expenses are recorded on the owner's personal tax return. The primary disadvantage, of course, is unlimited personal liability for anything that goes wrong associated with the sole proprietorship. Sometimes businesses will adopt what we call a fictitious name as a name that they put on the sign of their business. If I open an auto repair store and it's my store, I'd call it Jim Rusa, sole proprietor, doing business as, for instance, Acme Auto Repair. But it's still a sole proprietor. The next type of business is the partnership, which is the default form of business for two or more individuals. Again, no government filings are generally required, although there are some required that we'll talk about later in some instances. So simplicity of formation is the primary benefit of a general partnership. The disadvantage is that not only is each partner personally liable for his or her own conduct, each is also personally liable for the conduct of the other partners. The partners are agents for each other in that sense. All income and expenses are recorded on the individual partner's personal tax returns. The next form of business we talked about, which is the subject of this course, is the corporation. For the first time now, we're looking at a legal entity separate from its owners. It is a creature of state law. It doesn't exist except for the regimen established by the state to form these types of legal entities. Corporations, as artificial legal persons, are entitled to enter into contracts in the corporation's name, incur its own debts. It can initiate lawsuits and defend lawsuits. Everything that an individual can do, for the most part, a corporation can do. The primary advantage is that the owners of the corporation are not personally liable for the obligations of the corporation. Rather, the corporation as a legal person is responsible for its own obligations and debts and liabilities, assuming it's set up the right way and operated the right way. However, countervailing disadvantage is that specific filings are required in order to cause the state to recognize the existence of this entity, that is the filing of articles of incorporation. Also, because a corporation is a person, it is subject to income tax. There's also income tax on the profits when they're distributed to the owners. That's what we call double taxation. For that reason, at the federal level, the Internal Revenue Code provides for what we call a subchapter S election, which allows a state-formed corporation to file an election with the federal IRS to avoid the tax at the entity level, resulting in all revenue being taxed only at the individual level when it's distributed by the corporation to its shareholders. Closely held corporations are corporations whose shares are not traded on the public securities markets. They are also called closely held or private corporations. They are generally governed by not only the corporation laws of the state where they're formed, but oftentimes by contract among the owners of the closely held corporation. Publicly held corporations, on the other hand, are corporations whose shares are traded in the public securities markets. And as a result, public corporations are held to rather extensive disclosure requirements in terms of content and timing of disclosure. Federal level disclosures are regulated by the Securities and Exchange Commission. Public corporations are required to comply with state corporation laws as well as federal securities laws. The primary advantage of a public corporation is the liquidity of the investment on the part of the shareholders. They can sell it in the market at any time. The next entity we looked at was the limited liability company, sometimes described as a hybrid between a partnership and a corporation. It is like a corporation in that the individual owners of the limited liability company are not personally liable for the obligations of the limited liability company. Rather, the limited liability company is, again, a legal entity, a creature of state law that is responsible for its own debts and obligations. It's governed by Ohio Revised Code Chapter 1775. Partnerships are governed by Ohio Revised Code Chapter 1701. The primary advantages of a limited liability company is that there are fewer corporate formalities required than in a corporation. There's more flexibility in terms of structuring the ownership interests. In corporations, all shareholders are to be treated the same as it relates to their ownership of shares. In a limited liability company, there can be disproportionate benefits to equal owners depending on how it's written. The disadvantage, if there is one, of a limited liability company is, again, this requires the filing of documents with the Ohio Secretary of State in order to have the state recognize the existence of this entity. Also, a hallmark of the limited liability company is the adoption of an operating agreement, which is a combination of corporate bylaws and a buy-sell agreement among the owners related to not only internal corporate governance affairs, but transfer of the units in the limited liability company. An LLC is a pass-through entity. There's no tax at the entity level. All profits and losses are accounted for on the individual tax returns of the owners. Limited partnerships are another type of legal entity we discussed. They consist of a general partner who typically is responsible for management of the entity and has the ability to bind all of the partners to obligations. The general partner runs the company, has generally unlimited power to run the company, but also has potentially unlimited liability. That's the trade-off. The other types of owners of a limited partnership are the limited partners. They, as the name implies, have limited liability by virtue of having turned that responsibility and liability over to the general partner. Limited partnerships are governed by statute in Ohio. Ohio Revised Code Chapter 1782 governs limited partnerships in Ohio. There are filings required with the state in order to cause a general partnership to be formed. General partnerships are, although relatively uncommon, they are not uncommonly encountered as vestiges of prior legal work that you might encounter in your practice. Nonprofit entities. Nonprofit entities are just like they're like regular corporations, except they are not owned by individual investors. Rather, they're owned by stakeholders such as members or trustees or other quasi-public entities. They are formed under the auspices of the Ohio Secretary of State and are governed by Chapter 1702 of the Ohio Revised Code. Nonprofit corporations have generally the same liabilities as regular corporations. They have employees that can cause commitments to be made on behalf of the entity. They have a board of trustees, similar to a board of directors, that make the top-level decisions for the entity. They don't have shareholders. The profits of the entity must be recycled back into the operation in order for it to be nonprofit. IRS regulations heavily govern the operation of those nonprofit corporations formed at the state level who wish to enjoy federal tax exemption under 501c3 of the Internal Revenue Code. Before beginning to talk about partnerships, we talked a bit about agency, the concept that as a artificial legal entity, corporations can only actually conduct business or perform tasks through the human beings that are authorized by the corporation to act on the corporation's behalf. We looked at the restatement of agency third as the agency law in the state of Ohio. There's no agency code in Ohio. It is common law, and to the extent states have recognized the restatement of agency, that is relied upon for authority for agency concepts. Let's talk about liability from the agency relationship, because this is the issue that's most frequently encountered. When does the principal, in this case the corporation, incur liability due to the acts of the agent? We looked at the area of torts where we have independent contractor relationships, for instance, where the principal engages a contractor to act as the principal's agent to perform work. We looked at the employer-employee relationship and the concept of respondeat superior. What we determined was that the extent of the principal's liability to third parties for the actions of an agent relate directly to the level of control that the principal exercises over the duties of the agent and the extent to which those authorizations are made known to third parties with whom the agent does business. We learned that the principal and agent owe to each other, pursuant to restatement section 8.01, a fiduciary duty. The agent has a fiduciary duty to act loyally for the principal's benefit in all matters connected with the agency relationship. A concept that comes up not infrequently in corporations is the concept of apparent authority. When will a principal be responsible for the actions of an agent whom the principal has given certain trappings of authority? And this would happen in the corporation context if a corporate officer, for instance, interacts with a third party. That third party has a reasonable expectation that a corporate actor who's been given certain titles, certain trappings of authority, is authorized to act on behalf of the principal. If the principal later claims that the agent had no authority, that's where the battle lines are drawn for this concept of apparent authority. We looked at restatement 2.01 about the concept of actual authority and when it's reasonable for a third party to rely on what appear to be a principal's manifestations of authority to the agent. Apparent authority we looked at under restatement 2.03. Apparent authority is the power held by an agent or other actor to affect a principal's legal relations with third parties when a third party reasonably believes the actor has authority to act on behalf of the principal, and that belief is traceable to the principal's manifestations. In cases where the existence of the principal is disclosed to a third party and the agent does something that causes liability, the liability typically comes to rest with the principal. This is because the third party has been led to rely upon perhaps the existence of the principal, the authority of the principal, as opposed to believing he's simply doing business with the agent. In cases of an undisclosed principal, the agent is on his or her own, since the third party only knows of the existence of the agent and believes that he or she is contracted with the agent only. In terms of fiduciary duty between the agent and the principal, that fiduciary duty consists of the following. The agent must account for profits. The agent must act solely for the benefit of the principal. The agent must not act adversely to the principal, must not compete with the principal, must not use the principal's property for the agent's or any third party's purposes, must disclose information to principal. Now, let's start to talk about partnerships in a little more detail. A partnership is the default form of business for a multi-owner unincorporated business. As an unincorporated entity, partners are personally at risk. The body of law that governs partnerships in Ohio is the Revised Uniform Partnership Act, otherwise known as RUPA, which was adopted in 2010 in Ohio and adopted as Chapter 1776. 1776.01M defines what a partnership is. Also, 1776.03A confirms that partnerships are largely relationships dictated by contract between the owners. Throughout the statute, 1776, we see numerous provisions that begin with the phrase except as otherwise provided in the partnership agreement. In that sense, partnerships are similar to closely held corporations that are generally governed by contract. Pursuant to 1776.22, any association of two or more persons to carry on as co-owners a business for profit form a partnership, whether or not the persons intend to form a partnership. That means that even if we didn't decide, hey, let's form a partnership, if we combine in business a certain way, the law will consider us to be a partnership, and that can have significant consequences as it relates to not only dealings between the partners, but dealings with third parties. What are the factors considered by courts in determining the existence of one of these default or de facto partnerships? Pooling of resources. Have the partners combined their money in the enterprise that they're operating together? Control. Do the partners participate in management of the business together? Sharing of profits, losses. Do the parties divide up the money at the end of the day and allocate it between them? In terms of management and operation of the partnership, partners both have the right, or all have the right, to participate in the conduct of the business on a day-to-day basis. They all have the right to inspect the books and records of the partnership, and they are all responsible for the debts of the partnership. In the absence of an express provision in a partnership agreement, the Ohio statute contains many gap fillers for addressing situations that may arise in a partnership. For instance, 1776.41J states that a difference arising as to a matter in the ordinary course of business of a partnership may be decided by a majority of the partners. An act outside the ordinary course of business of a partnership or an amendment to the partnership agreement may be undertaken only with the consent of all of the partners. Although this can be covered off by contract, in the absence of a contract, these types of gap filler provisions kick in. Pursuant to 1776.31, each partner is an agent of the partnership and can cause the partnership to incur liabilities. That authority to incur liabilities on behalf of the partnership may be, in some instances, limited by filing a certificate of authority pursuant to 1776.33, which would put the world on notice of the business of the partnership and perhaps a public notice of the curtailment of authority of certain partners. In the Meinhard v. Salmon case, Judge Cardozo provided us with a mantra that we will use throughout the year. This is the principle that partners have a duty of undivided loyalty to one another. Joint adventurers, like co-partners, owe to one another while the enterprise continues the duty of finest loyalty, is the famous statement. The concept of a fiduciary duty among partners is codified in Ohio in 1776.44. Although partnerships are largely governed by contract, and some of the gap filler provisions in the statute, the ability to enter into contractual provisions in a partnership agreement is not unlimited. 1776.03 B3 provides some exceptions to that otherwise freedom to contract among partners and states that there are certain items that will not be enforceable if they're in a partnership contract. For instance, fiduciary duty to each other, access to books and records, and other things. In the absence of a contractual provision in a partnership agreement governing transfer of interests, under 1776.48, a partner's transferable interest in property is all that can be transferred. He or she can't transfer voting power without the consent of everyone else, but the partner can transfer economic power to a third party without the consent of the other partners. This is consistent with the concept that a partnership is a unique combination of individuals. Partnerships are dissolved pursuant to 1776.61 of the Ohio Revised Code. However, before dissolution, it's possible for a partner to withdraw from the partnership as provided in 1776.51. A disassociation or withdrawal of a partner does not necessarily result in the dissolution of the partnership. And a dissociated or withdrawn partner may still be liable for obligations incurred while he was a partner of the partnership, pursuant to 1776.56. Ohio law provides for the filing of a statement of dissolution, which may be used to put the world on notice that the entity has been wound up. That's provided for in 1776.65.